The backdrop to the October Monetary Policy Committee meeting is extremely complex, perhaps one of the most complex that we've seen in recent times. There's a lot on the table. Some of it the MPC can manage through its inflation targeting agenda. Some of it perhaps will have to be managed by the Reserve Bank of India more than the MPC. Telling you what's on the table, obviously growth inflation, the core mandate of the MPC will be up for discussion. The current account deficit is not the core mandate of the MPC, but in one way or another it may be feeding into inflation, so it would be up for discussion as well. The currency is hitting one record low after another. It would be imprudent of the MPC to ignore that. Liquidity conditions need active management, and of course credit markets have been nervous as well. So all of this is the mix that will go into the final decision that comes from the MPC. Along with that, you could see something coming in from the Reserve Bank of India as well. Remember, separate institutions there. Let's start with the growth inflation thing because that is of course the core mandate. Now remember, inflation last read was at about 3.69%, which is below the midpoint of 4% for the MPC's target. But the MPC is targeting 4% in a sustainable fashion. So they will be looking at what their forecast for year end was, which was 4.8%. Now that forecast itself would justify a tight monetary policy stance. Whether it will justify 3 consecutive rate hikes or not is up for debate. But at 4.8%, if the objective is to bring inflation down closer to the midpoint of 4%, tighter monetary policy would be justified. That was August policy. Now see what has happened since the August policy on 2 important factors, which is rupee and oil. Rupee has weakened by about 7% between the 2 policies. Oil prices are up in double digits between the 2 policies. So the MPC would automatically need to build in the upside risk that would come in on account of these 2 factors, and then take a call on whether another round of interest rate hikes is required. Also quickly mention that inflation expectations have been on the rise, and the business inflation expectations indicator from IIM Ahmedabad, which at least one MPC member, Ravindra Dholakia, tracks quite closely, has also shown some upward movement. So all of that taken could mean that a 25 basis point hike is fairly likely. Now come to the stuff which is not directly within the MPC's mandate, and here of course we're talking about current account deficit, the biggest problem for the Indian economy in the current year. At 2.5% to 3% of GDP, which is the forecast, we are in uncomfortable territory. We are near the red line. This in a year when actually we've seen outflows of 66,000 crore from the debt and equity markets combined. So we have a current account deficit problem, and we have a problem of funding that current account deficit. Now in this scenario, higher interest rates could help in 2 ways. One, higher interest rates could help balance out the savings investment imbalance, which could be leading to the current account deficit. It could also dampen demand to an extent, aggregate demand, and bring down, say, imports that we have seen, which have surged. On the second hand, you would also see higher interest rates draw in more capital, at least into the debt market. So if the MPC were to look at the current account deficit, it could be perhaps tempted to raise rates by 50 basis points. But remember, the current account deficit is not part of their official mandate. So if they do look at it, they would look at it through the lens of inflation. Then, of course, there is liquidity. Let's move on to that. That's a complex situation as well. Although this one almost entirely, to be managed by the RBI. The RBI has already done and said a lot to ensure that the liquidity deficit starts to normalize. And you will probably see a similar kind of stance continue in terms of active liquidity management, and that being assured to the markets when the press conference happens. So all taken together, the broad expectation in the market, and actually for the first time, everybody in the market wants a rate hike. So 25 basis point hike is almost entirely likely. With that 25 basis point hike, some people feel it's time for the MPC to abandon that neutral stance that they've held on to. There is some people who are talking about a 50 basis point hike, but that could be too much of a shock, especially if they are explaining it from a growth inflation viewpoint.